Hi, welcome back to another podcast with Mr. Hagan. On this podcast, we're going to continue looking at the classical responses to the Keynesian model, the classical criticisms of the Keynesian model. And I already talked on a previous podcast, about the lags as one of the criticisms. Now we're going to look at a little bit deeper criticism, because now we're going to look at the classical criticism of the Keynesian model itself, that maybe the model really doesn't work, and that criticism would focus on the shifting of the aggregate demand curve. So one of the things that a Keynesian likes to do is to increase spending in order to shift the aggregate demand curve. Now, let's say that government's going to increase spending in order to shift the aggregate demand curve for some reason. And if they increase spending to shift the aggregate demand curve to the right, okay, here would be your increase in government spending, and that increase in government spending is going to shift that aggregate demand curve to the right, so says the theory. But a classical economist might argue, they might say, well, no, wait a minute, if you're going to increase government spending, where'd the money come from? You had to get money from somewhere in order to increase government spending. So one possibility is you get the money from increasing taxes. That would be one way to do it. And then the classical economists might come back and say, okay, that's fine, but the problem is, if you increase taxes, then that's going to, let's go back to this, if you increase taxes, that's going to decrease consumption, because people will have less money in their hands. And so that will decrease consumption, which will just shift the aggregate demand curve right back to where it was before. So in other words, the increase in government spending will simply be offset by a decrease in consumption, And then the Keynesian might say, well, we're not going to raise taxes. That's not how we're going to deal with this. We're not going to raise taxes. So we're going to increase. So how are you going to increase government spending if you don't raise taxes? If you don't do this over here, you say we're not going to do this. We're not going to raise taxes. Well, then what? So the other possible way that government could increase spending without raising taxes is they could get the money by borrowing. They could go into debt. So they could borrow the money. Now, if the government borrows the money, then they're going to be competing in the loanable funds market to borrow money. So I go to the bank and I want to borrow money to buy a truck for my business, and while I'm in there trying to sign the paperwork to borrow the money from the bank, let's say I'm going to borrow the money at 5%, in comes the government official and he says, well, I want to borrow the money. And so I want to borrow the money to buy the truck. The government official wants to borrow the money to spend on whatever, to increase government spending. And so who's going to get to borrow the money from the bank? Well, I and the government official, we're going to get into a bidding war. And so I offer the bank 5.5%. And the government official says, well, I'll give you 6% to borrow the money. And so we're both trying to borrow money, and when the government enters into that market and tries to borrow money, it's going to increase interest rates. It's going to increase interest rates. And if interest rates go up, then that's going to decrease investment. That is to say that I wanted to borrow money to buy a truck, but the government official came in and just outbid me, offered a higher interest rate to the bank to borrow the money. I tried 5.5%. They said 6%. I said 6.5%. Government official says 7%. And then, I just, it's too rich for my blood. I'm out. I can't afford 7%. So as interest rates go up, now I can't do as much investing in my company as I wanted to. So government borrows more, interest rates go up, investment goes down, and that shifts the aggregate demand curve back in because of a decrease in investment, So a classical argument might be, well, okay, government official or Keynes, governments can increase spending, but they either have to raise taxes, which will lower consumption, or they have to borrow the money, which will raise interest rates and decrease investment. Either way, one of these two things is going to happen. so that the increase in government spending will be exactly offset by the decrease in private spending by consumers and investors. And so really what we're saying here is the government really can't shift the aggregate demand curve in any material kind of way, because it will always just shift back to where it was before. It'll always just shift back to where it was before. So this idea is called crowding out. This idea is called crowding out, where the government is crowding out private investors or crowding out private spenders when they increase spending. Now, I should say this here at the end. This is debatable. How big is the effect of crowding out is debatable. Maybe many of these resources were just sitting idle. You're in a recession. Nobody was looking to borrow the money anyway. Hagen really wasn't going. I really wasn't going to be in there borrowing money to buy a truck in the middle of a recession. So the resources were just kind of sitting there doing nothing. And now the government's coming in, borrowing the money, and that's really not going to lower investment because, the resources were just sitting there idle anyway. So how big is this crowding out problem? That's a debate in economic literature. We're not going to get into it here. I just want to say that it is open for debate. If the government increases spending, shifts the aggregate demand to the right, will that reduce private spending? And by how much will it reduce private spending? It's open for discussion. It's open for debate. So crowding out is another potential argument by the classical economists against the Keynesian ideas. All right, this has been Mr. Hagen on another podcast. Thanks for joining me, and I'll see you on the next podcast.